Good evening, ladies and gentlemen. Am I audible? Can you hear me? Please advise if I'm audible.
Wonderful. Yes, we can.
Okay, thank you for that. All right. So we are meeting again today for financial reporting and analysis. So as I've promised that I'm going to do at least 2 free lectures just to be a bit of an introduction to the subject before we start doing the calculations. So that's what we are here today. We want to do a bit of theory. And then once we've covered all the theory, from next week, we'll be working on the calculations, on the income statements and whatnot. So just as a reminder, for those of you that are interested in the classes, I think I've highlighted this last week, that is 750 Rand for the entire semester for financial reporting and analysis. And then for those of you that also need assistance with your KCQs, you can add an extra 100 Rand for each KCQ, and then we'll see how we can help you out. And then also at the end of the semester, if you need assistance with the OSAs, we'll be there to help. But essentially, what you are paying when you're paying the 750 Rand is you are going to get lessons for all the 5 units, i.e. we're going to go through the sole trader, the partnership, the company, the introduction, and the actual analysis at the unit number 5, right? And then we're going to do a bit of some homeworks, and I'm going to provide solution to those homeworks. And also we're going to do some past exam paper revision. We are going to go through past exam papers for 2021, for 2022, for 2020, to see how you would have answered them if you were in that particular exam, so that you prepare for your exams in is it what, November or December, right? So that's what you'll be getting for this, right? Then last week we covered a basic introduction of the topic, right, of accounting, where I was just highlighting the important aspects that you need to know about accounting before you go into the deep end of accounting. So I highlighted about the definition of what? Of accounting, where I said accounting is about the measurement, right? It's about the measurement of different financial information of economic entities, right? And then we talked about the difference between financial accounting and management accounting, where we said that financial accounting is about reporting, right, the previous year's financial information, right? So that's what that's what we are doing in this module. But there's also management accounting, which is accounting for managers, where you're now using that information to make decisions within the business. This one you're going to do it in your 2nd year. I think it's 2nd year, 2nd semester or 1st semester, I don't really remember, but you're going to do it in your 2nd year, the management accounting. Then we talked about some common accounting terms, right? Where I highlighted that there are some terms that you need to know in accounting for you to be able to talk the accounting language. There are some terms that you need to know for you to be able to talk the accounting language. So some of those terms I highlighted that you need to know what are assets, you need to know what are liabilities, you need to know what is equity, you need to know what is expenses, and you need to know what is income, right? Your understanding of these 5 particular terms is basically what will guide you through the entire module. Because the whole module is about categorizing. That's what the module, remember those homeworks that I gave you guys? The whole module is about categorizing information. You need to be able to tell whether a specific thing is an asset or a specific thing is a liability, or whether a specific thing falls under equity, or whether a specific thing falls under what? Under income, right? So you need to be able to tell that. So when we are done with this lecture, I'm going to send you guys the solutions to the homeworks that we did last week, that I sent you last week. But before we are done with the lecture, if there is anyone with a particular pertinent question on those homeworks, you are free to ask right now. In the next maybe 2 or 3 minutes, we can just discuss some of those issues that you might have faced while doing the homeworks. But the solution for the homeworks, they will be made available after the lecture, right? Is there anyone who tried the homeworks and faced a specific challenge or a specific question that they have? Okay, trust you all happy, but definitely you should definitely attempt those homeworks. I encourage you to do that because it will teach you quite a lot about categorizing financial information. Because like I said, you're going to be doing quite a lot of that during the semester. You'll be categorizing financial information. You'll be categorizing, does this fall under assets? Does this fall under income? Does this fall under this specific bracket? Because that's what financial statements is all about. It's just about categorizing information. Because you have a format that your lecturer provides you, that you should present your income statement like this, you should present your balance sheet like this. What you have to do as the student is to be able to tell this falls under this heading, this falls under the assets heading, this falls under the liabilities heading, this falls under this specific heading. Once you know that, you are good to go. Financial reporting analysis, you will not have any specific problems. So for today, we are now starting on your unit number 1, right? On your unit number 1, that's what we are doing today. So some of the aspects of unit number 1, we already covered it in our last lecture. We already covered some of the aspects, because remember last week we were doing an introduction. So unit number 1 says understanding financial statements. That's unit number 1, right? So I just wanted you to see, so that if you're following through the study module, you know where we are. Right. So you can see the first thing, role of financial statements, and then users of financial statements, generally accepted accounting practices, the value and limitation of financial statements, characteristics of good financial statements, classification of financial information. This is what I'm talking about. That's very, very important. Once you understand that, you find everything else will be easier. And that is what we did last week when we were talking about assets, liabilities, and whatnot. So this one we've already covered it, although we will constantly be returning to it as we go throughout the semester. Then the last one is summarizing the financial information in the financial statements. Now, this is where the working starts. This is where the work that we start to be doing, starting from next week, because this ties into all the other 3 units that we are going to be doing, where we're discussing all the different things, right? Okay. All right. So let's talk about the role of financial statements, right? The role of financial statements. So before you even talk about the role of financial statements, you need to understand what are financial statements. What are the statements that we'll be talking about for the rest of the semester? So there are 4 key financial statements and 1 additional one, which I've added here just for the sake of your knowledge, because you will notice it in the exam, sometimes it pops up. But there are 4 key financial statements that you need to know about, right? So there's what we call the statement of financial position. There's what we call the statement of comprehensive income. There's what we call the statement of changes in equity. And there's what we call the statement of cash flows. So those are the 4 key financial statements that you need to know about. But in addition to this, you need to know about what we call notes to financial statements. And also you need to know about what we call the trial balance, notes to financial statements and the trial balance. But because you guys are not accounting students, right? We are not going to go deep into the notes to financial statements, and we're not going to go deep into the trial balance, right? How the trial balance is created, because that's now for deep accounting students. They are the ones that are supposed to create the trial balance for you. But you, as a manager at the workplace, you are given the trial balance, and you're expected that from the trial balance, you should be able to extract enough information to create some financial statement. So you notice that most of the questions that you receive, they will already give you a trial balance and then tell you that from the trial balance above, can you create a balance sheet? Can you create an income statement and whatnot, right? So the first statement is the statement of financial position. Now, there are templates in your study module. We'll go through them one by one into deeper detail in whatnot, right, starting from next week. But for now, we're just going an overview. The statement of financial position. So the role, right, or the definition of a statement of financial position, right, it is the statement that gives you, right, the nature, the state of the business at a particular point in time. Right. So it tells you, remember, you now know the definition of assets, liabilities. That's why I was saying it's important. It tells you how many assets does the company have on 10 August, right? How many liabilities does the company have on 10 August? How much equity does the company have on 10 August? So it gives you a summary, right, of the value of a business on a particular day, the financial position of a business on a particular day. So you will notice that when we're talking about the statement of financial position, we say the statement of financial position of Vodacom Limited is at 31. The reason why we're saying is at 31, we're saying that it's valid for only one day. If you go to the next day, it's no longer valid. You have to change it because things could have changed. They could have used the cash that they had yesterday. They would have borrowed more money. So things can change in an instant for the statement of finance. It's a snapshot. Usually call it a snapshot of the financial position of a company. Another term is also called the balance sheet. So you notice most of the time we use the term balance sheet instead of statement of financial position. So either statement of financial position or the balance sheet. The reason why sometimes we like calling the balance sheet, that's the one that I was telling you, it has to balance at the end of the day because it follows the accounting equation, right? Where we said assets is equals to equity plus liability. It has to follow the accounting equation. So that's statement number one, right? Its role to show the state of a business at a particular day. Right. The next one is called the statement of comprehensive income. Also, we can call it the income statement. Sometimes we call it the profit and loss account or the P&L account. Right. So the statement of comprehensive income, it simply summarizes the financial performance of the business over a period of time. Statement of financial position, snapshot over one day. Right. Statement of comprehensive income over a period of time. It could be a month, it could be a year, it could be 10 years or whatever it is. But most of the time, it's usually 1 year, right? It's usually 1 year most of the time. So that's comprehensive income. So the comprehensive income now includes the income and the expenses. So financial position, assets, liabilities, and equity. But statement of comprehensive income, it is divided into the income and the expenses. So you can already see why I was saying that those things are important to know how to categorize those things. Because if you already know what are income and what are expenses, you know how to do the statement of comprehensive income. Because you know that this goes to income, this goes to expenses, this goes to assets, this goes to liabilities. You put it in the proper order and you're done. Right? So that statement of comprehensive income. The purpose or the role is to show whether you have made a profit or a loss in a particular year, i.e. to measure the performance of the company for that particular period. So that's the comprehensive income. Then the next one is called the statement of changes in equity. Now, a business by its very nature, it's owned by someone. Someone owns the business. It's someone's business, right? So you want to know that at the beginning of the year, how much did that person own in that business? And then at the end of the year, how much do they now own in the business? So what is the value of their ownership within that particular business, right? So on the statement of financial position, you have a figure which will tell you that this is the current equity, right, of the of the business owner. But the statement of changes in equity will show you what happened to that equity over time. So it compensates, because remember, financial position is snapshot one day, but the equity, it will show you that over the last year, this person had 30,000 invested in the business, but after 1 year, he now is 45,000 invested in the business, or he now only is 2,000 invested in the business. He sold all of his equity to someone else, or he borrowed some money, whatever has happened in the year in terms of the equity of that business. Then the next one is called the statement of cash flows. Now, the statement of changes in equity, right? This is specifically for a business, for ownership of a business. But if you don't have a business, sometimes it's called the capital account if you're a sole trader. Sometimes it's called the capital in current account if you're a partner, right? You'll notice there's usually a question that your lecturer likes about the capital in the current accounts under partnership. We'll do it when we start doing examples, right? And then the third one, the fourth one, statement of cash flows. Statement of cash flows is basically a person asking you this, right? I can see that when you started the year, you had 33,000 cash in the bank. But I can see that at the end of the year, you know, you've got 60,000 cash in the bank. What happened during the year? How did you end up with 60,000? So that's what the question that you're trying to answer. Right? You're trying to answer, what cash did we receive? What cash did we pay? Now, cash and profit are two different concepts. You understand this clearly when we start doing the examples, because there are profits that can be gotten that are not cash. So cash and profit are two different things. So businesses prepare a statement of comprehensive income on a non-cash basis. And then they prepare a statement of cash flows to explain what happened with the cash that started at the end of the year and that they have at the end of the year, so that, you know, no one is stealing cash or something like that, whatever you want to explain. So it just shows you what were the cash flows that were happening during the year. Now, there are three major categories about those cash flows, but we'll talk about them when we get to that particular juncture, right? Okay, so then, like I said, those are the four major statements that you need to know about. But in addition, for your information, the notes to the financial statements. Now, there is some information that I'm going to talk about in about 5 minutes time or so, right? So when you are preparing financial information or when you are preparing financial statements, right, you need the reader of the financial statements to know the assumptions that you make. You need them to know what rules did you use, what frameworks did you use, how were certain things done. Right. So those are the notes. So usually, if you check, even if you go to the Johannesburg Stock Exchange, if you download those accounting reports, you notice that there's a statement which says notes to financial statement, and it's like 10 pages long. These are just notes just to support. You see that figure of 80,000 in the balance sheet. This is how we calculated it. You see that statement where we said this, we made this assumption for us to arrive at that particular thing. So that's what notes are. It's just an explanation of how did you arrive at the figures. Then lastly, what, like I said, the trial balance. The trial balance, we'll talk about it deeper when we do the examples, but the trial balance is basically a summary of all of the accounts of a business. Right? So a business, remember I said we'll talk about what we call T accounts. So a business, when they are recording everything, if they buy a laptop, they have to record that they bought a laptop. If they buy a diary, they have to record that they bought a diary. If they pay wages, they have to record that they pay wages. So all of these records are kept in what we call the accounts of a business. That's the responsibility of the bookkeeper. That's not your responsibility, guys. So you don't need to worry about that. But that's the responsibility of the bookkeeper. He is keeping the books of the business, recording everything. Now, once he has recorded all of these things, he cannot give you all of the accounts as the manager and say, these are the accounts for the year. You will not make sense of what he was recording. But he will give you a list of the balances in each and every account. That is what is called the trial balance. Just a summary of everything that happened during the year. Then you take that information and then you now create your balance sheet, your income statement, your current accounts, and your cash flow statements from the trial balance information that you've been provided with by the bookkeeper. So that is what you need to know under the role of financial statements. So number one, financial statements provide you the financial position, i.e. how many assets, liabilities, and equity a company has through the balance sheet. Right? Financial statements show you the performance of a company, i.e. how much profit or loss was made through the income statement, right? Financial statements show you how the ownership of a company has changed over time through the statement of changes in equity. Then financial statements show you how the cash of the business was used up during a particular period in time through the statement of the cash flows. Then lastly, they can also provide you detailed information about how certain figures were calculated, how they were arrived and whatnot through the notes to the financial statements. So that's a role of financial statement. I don't know if there's any question. Always feel free, guys, to ask if there's any question on what I've highlighted. Right. So financial statements, right? We've highlighted them, right? They are used by someone. There is a reason why we create them, so that they can be used in a business. So who are the users of financial statements? and why do they need financial statements? So there are what we call internal users of financial statements and what we call external users of financial statements. Internal users of financial statements include the owners of the business, include the employees, and include management. Right? So these are people that use the financial statements internally. So you need to know what exactly do they need them for. So for management, for example, they can use financial statements for management accounting. They use financial statements to make decisions. Right? So for example, a manager, if they look at the financial statements and they see that, oh, we have got an overdraft of 30,000, which means that they can start making decisions to reduce the amount of cash that is being used by the business, so as to eradicate the overdraft and the interest payments attached to the overdraft. Employees can use the financial statements to make a decision. Should we ask for a salary increase this year, or should I stay in this company? So if you're looking at the financial statements of your company, for example, let's say you're looking at financial of Vodacom, and you see that Vodacom has made a loss this year, and last year it made a loss. It means you start getting worried. Will this company survive? Because the company cannot make losses and survive. It has to close if it continues making losses. So you start looking for employment elsewhere. So that's an example of how you can use financial statements as an employee. Or if you see that they're making profits, they made 3 billion profit rand this year, they made 5 billion profit rand next year, you can then start negotiating. I think we are due for a 5% salary increase at this company. Right? Why? Because they're making profits. Right? So you are using financial statements. Then as the owner of the business, you also want profit. You also want dividends. Right? You also want to withdraw some money from the business. So if the business is making money, you can now can I please leave some money to go and eat with my family, right? Or if the business is making losses, maybe you need to actually deposit money for the business to survive as the owner of the business. You need the report of how the business is operating. So those are internal users. Then there are external users of financial statements. These are people that are outside the organization, including banks, creditors, auditors, government, and outside investors. Right? So for example, a bank, if you approach the bank and you want a loan, they will ask you for your financial statements. Why? Because they want to see, are you able to pay back the loan that you want to take from the bank? Do you have a business that is surviving, that is profitable? Do you have enough cash flows to pay the interest that they're going to charge you each and every year? So they are going to do that. They need the financial statements for that, right? Then your creditors or your suppliers. Remember, creditors or suppliers can give you terms. You buy inventory or you buy stock as a business, and they can tell you, oh, you can pay it after 90 days. The only reason why they are saying you can pay it after 90 days is because they believe that after 90 days, your business will still be surviving. So the way they see that is they can assess your financial statements so that they can offer you credit terms, discounts, or maybe it's a partnership that you want to make with their suppliers, right? You can only do that after they've analyzed your financial statements. Then the government, regulators, tax authorities, they want to charge you tax. The only way they can charge you tax is if they assess if you made a profit or not. If you made a profit, then the government comes in, charges you 28% income tax on the profits of the business. So they need your financial statements. Auditors, they want to see if you guys are honest, you're not stealing money from the shareholders, and the only way they can see that is by assessing the financial statements of the business against the source documents. Then investors, someone wants to come and invest into your business. They are not part of the business, they want to invest. They will ask for the financial statement so that they can assess, does this business have a future? Will it give me back my money? So those are the users of financial statements. Again, if there are any questions on these users, you can ask. Okay. Then the next thing is the accounting practices, the generally accepted accounting practices. So remember, I talked about the bookkeeper, who I told you is the one who gives you the trial balance, or the one who keeps the accounting records of the company. So when the bookkeeper is keeping the accounting records of the company, just think of it this way, right? If I have my bookkeeper doing their own things and another company has got their bookkeeper doing their own things, it becomes difficult for us to compare or for us to trust the information because everyone is doing their own thing. Right? But there are organizations that came together and decided, let's create standardized statements that everyone across the world can use and can understand. So that if I go right now and look at the statements of Vodacom, and look at the statements of MTN, and look at the statements of the Bears, look at the statements of a company in America, Tesla, right? I can quickly understand them because they have been standardized. They are generally accepted accounting practices that if you are creating a balance sheet, if you are creating a statement of financial position, it should at least have a heading which says assets. It should at least have a heading which says equity. It should at least have a heading which says liability. And this is what we have agreed are called assets. This is what we have agreed are called liabilities, and etc. So that's what GAAP is basically all about. It's just a framework of what accountants all over the world have generally agreed that this is how you prepare your statements of financial position, of income statements, and what not. Now, in South Africa, they are managed through what we call SAICA, right? The Institute of Chartered Accountants and whatnot, right? And then they are based on what are called the International Financial Reporting Standards, right? Just the basic information. You don't need to get too deep into some of these things. Just some basic information, right? Okay. So now, these standards, right? These are organizations, right? Are the GAAP in the IFRS and whatnot. There are certain principles that they've agreed that for you to prepare your accounting records correctly, these are the things that you need to consider. These are the principles of accounting that you need to consider, right? So these things that I'm going to talk about now, these are now the building blocks of you understanding what goes under assets and what goes under liabilities, what goes under income or what does not go under income, whether a particular figure should be included as it is, or it should be divided up, removed, subtracted, added, and whatnot. This is now the basis of how you create your reports. So the first thing, for example, is that when you are doing your financial reports, everything should relate to one specific entity, right? So it's called the accounting entity concept. So what am I saying? I'm saying that, for example, if I, right, for example, I myself, I've got a company that's called TKV Enterprise, right? So if I am preparing the financial reports of TKV Enterprise, I cannot then include things that have nothing to do with TKV Enterprise. So for example, maybe I went out for lunch with my family, right? I cannot take the money that I went out for lunch with my family. That's a GEMS or a Jasper expense. That has nothing to do with TKV. I cannot take that expense and then include it in my in TKV Enterprise and say that this is TKV. This is not TKV. That was me and my family enjoying a Sunday lunch, right? So that's accounting entity. We're saying that the transactions relating only to the entity should be included in your in your four statements. Anything else should not be included. So for example, if I bought some stationery, right? This is a typical example now. If I bought some stationery, right, for the company, and then my kid, right, Tinashe, comes in and then takes some of the stationery and uses, we have to remove that stationery now from TKV because it's no longer under TKV. No one at TKV Enterprises has used that that stationery. It has been used by my kid. So it's no longer part of TKV. We have to say the owner of the company withdrew some money from the company. So that's out of the profit of the company, but that's not an expense for the company. So it does not fall under expenses because it's not for It's not for TKV. It now falls under equity because we're saying it's a drawing or a withdrawal from the company. So you need to understand some of those nitty-gritties. We'll see when we do examples. All right. So that's concept number one, accounting entity. Concept number two, money measurement. Right? Money measurement, we are simply saying that when we are doing our financial statements, we are not adding cows and tables and forks and cups and books. We are adding rands. So everything should be in a measurable unit. For example, rands, or maybe if you want, you can use the US dollar, or you can use the whatever other currency, the dollar that you want to use, right? But in essence, you are using one currency. Everything should be measurable, right? That you are putting into the accounting. If it's not measurable, then you cannot include it in there. You have to be able to measure it under one currency. in the financial statement, right? That's number two, concept number two, money measurement. Concept number three, materiality concept. Materiality concept, we're basically saying that, does it really matter? The thing that you're talking about, the thing that you want to include in the financial statements. So for example, in my company, if I buy a car for the company, that's going to cost us what? Not towards of 200,000 rand, right? So that matters. That is going to have a material effect on the business. But if I buy some, some sweets, right, for 50 cents, right, I cannot go in this financial statement and say sweets 50 cents when the profitability of the business is in the millions. That would distort the view because you end up with a long financial statement. So what ends up happening is I can end up just with something that says miscellaneous expenses. And then under miscellaneous expenses, I add up everything else and put it under there. But I will now have motor vehicle expenses. I now have got rental expenses. I now have got water and electricity expenses, and then everything else and bunch it up under what? Under miscellaneous expenses. So that's what materiality means. It means if something is not that big, if it is not that important in what you're doing, then you should not take too much of your time doing it in accounting, right? So that's materiality concept, right? And then that's number three. Number four, we can talk about historic cost. Now, this one confuses a lot of people, right, that are not accountants. So historic cost, we're saying that when you buy an asset, it is recorded at the original cost. So if we buy a building, right, for our company, right, in 2000, and it costed us 300,000 rand, right, in the balance sheet, in the statement of financial position, that's what we are going to write, that this building 300,000. Yes, we can add extra things and whatnot, but the cost of the building is 300,000 rand. We start from that point, then go forward and try to do whatever we want to do. So the original cost to the entity is what is recorded in the in the statements of the organization. Although the value might be different, because you bought the building for 300,000 rand in 2000, now it's worth probably 1 million. But we don't record it as 1 million. Of course, for the actual accountants, you might be arguing that you are wrong there. Yes, I am partly wrong, but you know what I'm trying to say. You can revalue it over time and whatnot, but it's not something that you do every year. But normally, you record it under the historic cost of that particular business, right? So that's concept number 5, I think. We'll go to the next concept. Double entry concept. The double entry concept, now this mainly applies to the bookkeepers. For you guys, it's not that important, but it mainly applies to the bookkeepers. We are saying that for every debit entry within your accounting system, there is a credit entry. So when you are putting your accounts, remember I said we'll talk one day about the T accounts. When you're putting your accountings, right, everything is recorded twice in accounting. Everything is recorded twice. Remember that the accounting equation that we did last week, where we said assets is equals to what? Equity plus liabilities, right? So for example, if I start the business and I deposit 100,000 into the business, how do we record 100,000 twice into the business? Number one, we record it and say that there is new equity that has come into the business plus 100,000. Then we say also there is new cash, because cash is an asset to the business. There is new cash that has come into the business, i.e. 100,000. So you see, we've recorded it twice, right? We've recorded it what? We've recorded it twice. Or let's assume that I've taken that 100,000 and I've bought a car for the what? For the company. How do we record it twice for the business? So we are saying, number one, there is less cash. We have recorded a withdrawal of cash of 100,000. Number one. And then number two, we've recorded an addition of a vehicle, an asset. So you've recorded it what? You've recorded it twice. So that's how accounting happens. Everything is recorded twice. It affects two separate accounts. That's what double entry is all about. Like I said, this one is not that critical for you guys, but when we find time, we'll discuss about T accounts and whatnot. All right. Next one. Going concern concept. Now, the going concern concept, we are simply saying that when you are reporting your business, your financial statements for the business, you are assuming that the business is not going to close down next year. That's your assumption. You're assuming that this business, it will survive for the next 3 years, for the next 5 years, for the next 10 years. You're assuming that the business will continue to operate. And this is the reason why we use the historic cost when we are doing our assets. Because if we are assuming that this company is going to close next year, then there's no point in saying the building is worth 300,000 when it is not worth 300,000. We have to revalue it, right? So because we are assuming going concern, we use historic cost concept, right? But if we remove the assumption of going concern, then we have to liquidate everything. We have to ask ourselves, what is the actual true value of these things that we are recording? Right. So going concern concept, we're just assuming that the business continues in perpetuity, that the business will not close down. It will continue for the foreseeable future, right? So that's another accounting concept. Next one, accounting period. Now, this one is straightforward. When you're doing your account, you have to highlight what is the period, right? If it's a balance sheet, give us the day of the balance sheet, 31 December 2020. If it is a statement of comprehensive income, give us the period. Is it for 1 year? Is it for 3 months? Is it for 1 month? What period is it? Normally, when you are answering your exam questions and the assignment questions from your lecturer, usually the accounting period is from 1 March up to 29 February. There's a reason for that. SARS, taxes and whatnot, but don't worry about that. But usually that's the accounting period. Usually, in quotes, usually, it's from 1 March of a particular year, going full year up to 29 February of the next year. You will notice most of your examples are going to be exactly like that. They'll be from 1 March up to 29 February, usually 1 full year. So be very careful when you're dealing with these things to see what the dates are that you have been that you have been given, right? Then, now let's go to the interesting concept, the matching concept, right? The matching concept simply says that you have to match income and expenses. You have to what? You have to match the income to the what? To the expenses. So let me give you an example. So let's say that you are a project manager, right? You are a project manager. You do buildings. That's your project, right? So you enter into a contract. The client tells you, can you build a building for us, a skyscraper? It's going to take you 3 years, for example. And then after 3 years, the client is going to pay you, let's say 1 million rand, right? After what? After 3 years, right? But remember, it's a building, which means you're going to be expensing things, right? So in your first year, you use up 500,000, 50%, right? In your second year, use up 200,000. In your third year, use up 100,000. Those are the expenses that you used. Now, the question to you is, do I record the expenses in each year and then record the amount that we receive in the last year, right? Is that what we do? Unfortunately, accounting says no. You should match, because the income that you're going to receive in year number 3 should be matched to the expenses that you accrue in each and every year, which means you're going to take that income, you're going to pro rata it each and every year so that it makes sure that each year there's some money that is coming in, there are some expenses that are going out. Although physically, you might not receive the actual cash from the customer, but in your records, you have to do pro rata basis. You have to match your income and your expenses. So that's your matching concept, right? Go to the next one, conservatism. Conservatism was saying that don't overestimate your profits and don't underestimate your expenses. Now, this one, you understand it better when we go to examples. But essentially, we're saying that if someone, for example, just look at your own life. If someone borrows you money, let's say they owe you 1,000 rand, right? If you think that this person is not going to pay me back my money, I think there's like a 50% chance I'm not going to get my money back from this person. Then you cannot go into your financial statements and record that this person owes me 1,000 because you know that this person is not going to pay you your money. So you are what? You are overestimating your revenue if you record all of that. So you make a provision. You say 50% chance that he's not going to pay me back. So let me just record it as 500. What? Instead of what? Instead of 1,000. So that's conservatism. So we're saying that if there is income that you are unsure of, underestimate it, right? If there's expenses that you are unsure of, overestimate the expenses. So don't overestimate income, don't underestimate expenses, right? Make sure that you are conservative in your approach of how you give certain what valuations and figures, right? So that's conservatism. And then you go to the next one, which is realization principle. Realization principle, we're just saying that if you've realized an income, please record it. If it is unrealized, please do not record it. So for example, let's talk about Forex, right? Or shares. Let's talk about shares. I think shares can be a good example. Let's talk about shares. So if you buy, if you bought, let's say some Vodacom shares at the beginning of the year, let's assume that they were going for 100 Rand when you bought them, right? And now today the price is 400 Rand for the share, which means that they've gained 300 Rand. So that's profit. But have you sold the shares yet? If you have not sold the shares, it means that that money is not in your account. It's called unrealized profit or unrealized gain, which means that tomorrow the price of the shares can go down and you can lose that because you did not sell your shares. So because of that, you cannot go into your financial statements and record it because you do not have the cash with you. But if you then take that share and sell it and get the 300, then you're saying this is now realized gain, and you can now record it carefully into your financial statement. So that's what we're saying. You can only put something there if it has been realized. If it has not yet been realized, please find another alternative of presenting your your losses or your gains. Okay. Next one, accrual principle. Accrual principle is almost the same thing with matching, but slightly different. So we are saying that, I'll give you this example. If you don't use prepaid, let's assume you don't use prepaid water. So you use water for the whole month of July, right? And then at the end of the month, in August, you're going to get a bill from the water council for the water that you used. Is that bill for August or it's for July? It's for August. It's for the last month. You've already used it in the last month. So if you are going to do your recording of your finances, you cannot record the bill in August. You have to record it in July because that is when you use the water. So that's what the accrual principle is all about. It's saying that expenses should go into the correct year. If you used up the resources in a particular year, that is when they are supposed to be expensed, not in the future, right? So that accruals are principle. So some of these things you see them when you start to apply them. I will highlight to you that here we're applying accruals, here we're applying all of these are different things, right? So this becomes the end of your accounting concepts, right? This becomes the end of your accounting concept. So we're gonna go through just a couple of other things, right? Just to explain a couple of other things. But are there any questions on the accounting concepts that we've talked about? Okay, I trust there. No. Okay, so now limitations, right? So we've highlighted, okay, see someone posted something. Wonderful. So we've highlighted what is the role of financial statements, right? We've highlighted different types of financial statements, right? And then we've highlighted the concepts that are used in creating the financial statements, right? Now, once you have created the financial statements, are they 100% correct? What are the limitations that you need to know that maybe I should not use these financial statements? Now, the reason or the limitation for someone to doubt financial statements is number one, the concept that I talked about, historic cost. You bought a building in 2000, it was 300,000 Rand. The building is now worth 1 million, but you have recorded it as 300,000 Rand. So that is a limitation. It means you are not giving us the true value of the business. You are understating the value of the business. Number two, inflation. If the prices are constantly increasing, then financial statements become irrelevant. Why? Again, historic concept. So if the price is increase, it means that the value of your assets are greatly understated. They are no longer worth what they are intended to be worth. Then non-monetary items. So there are certain things that are not recorded in the financial statements. The number of people working at a company, the kilometers that you drove at the company, the number of units that you actually sold, all of those things are not recorded in the financial statement. Because remember, they are monetary. We want things that are monetary. If it's not monetary, it's not in the financial statement because of the measurement concept that we talked about. So because of that, that's another limitation in terms of the financial statements, right? Then they are backward looking. Financial statements tell you the past of what has happened in the past. They don't tell you what is happening in the future. So an organization can give you financial statement with a profit of 1 billion, but guess what? Next year, that organization can close down. Maybe it can be sued. Maybe it can lose all of its resources and whatnot. So you don't know what's happening in the future. You're only looking at the past. So that's another limitation of financial statements. Then different companies can use different accounting policies. Now you might question me, what about GAAP, James? You told us about GAAP and IFRS. What about those? Yes, GAAP and IFRS, they tell you the generally accepted standards, but it does not mean everyone follows through everything that is written there. Sometimes, they cut corners. Sometimes there is leeway. You are given 3 choices. You can choose whichever one you want. So because of that, there can be differences in terms of how certain things are presented. Then lastly, what we call unrecorded value. Unrecorded value, there are things that you cannot monetarily measure them. For example, the reputation of an organization, the goodwill of an organization. So for example, the name Coca-Cola. If I get the name Coca-Cola right now, I can start my own bottling company and make money just because I'm using the name Coca-Cola. But if I ask you what is the value of Coca-Cola on the balance sheet of Coca-Cola, you might not even find it there because it's unmeasurable. People will start lying to you if they start measuring that thing. Right? So that's another weakness of our financial statements, right? So those are the limitations. Let's see what else can we discuss before we close the meeting. Okay, characteristics of a good financial statement. So some of these things is now just basically a bit of repetition of what we've already talked about. So characteristics of good financial statement. How can you tell that this is a good financial statement? Yeah, this accountant knows what he's doing. I should definitely use this financial statement. Okay. Or is this thing taking time? So it should be understandable. I think that's self-explanatory. If someone looks at your financial statement, do they understand the information that you're trying to convey? It should be relevant. It should give the person information that they need. If they need information about assets, are the assets there? Are the assets current? Are the assets recent? It should be prudent, i.e. there's no overestimating or underestimating. There's no bias in how they were prepared. Right? It should be neutral. You should not be prepared with someone in mind that I want to prepare this for SARS or I want to prepare this for this specific person who wants to buy my business. They should be neutral, right? They should be reliable, i.e. you should be able to verify them. These accounts are audited and whatnot. They should be reliable. They should be complete. Nothing should be missing from the financial statement. Every single information that you need should be there. Then lastly, they should be comparable. If you take financial statements for Vodacom and for MTN, you should be able to compare and see which of the 2 businesses is making a profit. Right? So this brings me, if I'm not mistaken, let's see. This should bring me to the end of the theoretical aspects of your study module. So anything that we do afterwards is now finances. All right. So I think we've finished up to 1.6 now. Then 1.7, we did it last week. 1.7, we did it last week. Let's see. 1.7, we did it last week. Where we're talking about the what? The assets, the liabilities, the income, and the expenses. And then we talked about the what? The accounting equation. So we did this last week. And then now we are on 1.8, summarizing financial information in financial statements, right? So this is where we are going to pick up from when we start what next week. But I will just highlight 1 or 2 things for the next 5 minutes before we close the lecture. But this is where we are picking up from next week, so that once we are done with that, then we can start doing questions and whatnot. Because unit number 3, unit number 4, unit number 2, unit number 3, and unit number 4. The best way to learn those units is to actually do questions. So we're going to be doing a lot of questions. But before we do a lot of those questions, we just need to have a basic understanding of what an income statement is, what a balance sheet is, what a statement of changes and equity is. So that's what we'll be doing. in the following week. Then after that, we start doing questions until the end of the semester. Then we'll do the last chapter, which is the financial analysis. Now, I will just introduce, just for a few minutes before we close, the statement of comprehensive income on 1.8, right? Statement of comprehensive income. So remember what we said. Comprehensive income. We are simply saying, what are your income and expenses? That's why we call it a profit and loss account. It's called statement of comprehensive income, or an income statement, or a profit and loss account. We are just trying to say, how much profit did we make? And for you to be able to calculate how much profit was made, you need to know what were the income of the organization and what were the expenses of the organization. Once you know those two things, then you can calculate the profit of that particular organization. So the format for this one is very, very standard, right? I'm just going to give you a standard format, but when we go now to sole trader, when we go now to a business, to partnership, there might be slight changes that you might then see. But the standard format is basically, you're going to take your sales, right? Your sales, we're saying, how much did you sell? So, for example, let's talk about a simple business so that we are all on the same page. For example, let's say that you are in the business of selling furniture, right? So we're saying, how many television sets did you sell, right? That's the furniture that they're selling. How many television sets did you sell? Or maybe you're selling laptops. How many laptops did you sell as business, right? So the number of laptops that you sold multiplied by the price, and you get your what? You get your sales for the particular year. But whenever you are selling something, sometimes customers come back. Sometimes customers what? Come back. And when they come back, what do? They say, look, I don't like this product, it's not good quality, give me my money back. That's what we call sales returns. So whenever you're calculating sales, you need to make sure that you check, were there any sales returns? And then you what? You remove them from the sales, because you did not sell it, because it came back to you, right? So that's sales. That's something that you need to know. Once you have calculated the sales, then you remove the cost of the sales. So what is cost of sales? Cost of sales, we are simply saying that for you to sell the laptop to someone, right? Maybe you did not manufacture the laptop. So for example, if you go to these people that sell laptops, right, Incredible Connection. Incredible Connection does not have a factory. They don't manufacture laptops, but they sell in there. There's HP, there's Dell, there's Lenovo that they're selling, which means that they are buying these laptops from someone. So the sales that they made, there was a cost attached to the sale. So for them to sell you a laptop, they had to buy the laptop from someone else. So that is what we call less cost of sales. We're saying, how much did I sell? Less, how much did I pay the manufacturer for me to get the sales? If we want to overcomplicate it, for you guys, don't worry, we're not going to overcomplicate it. If you want to overcomplicate it and say you are actually the manufacturer, then you can now talk about opening stock, purchases, closing stock, and whatnot. If there are examples like that, we are going to do them. But just for the sake of insanity, just think of it that way. If you're selling laptops, you bought the laptop from someone. What was the cost of that laptop? So once you have removed the cost of that laptop, what you are left with is what we call the gross profit, which is a positive figure. Right? Then after the gross profit, you're now asking yourself, was there any other money that I received as a business? So for example, let's say you're Incredible Connection. Maybe you've got a building where you are selling your laptops from. But in your building, it is too big for you to use. So you're only using one small part of the building. And then you go to ShopRite and say, look, guys, we've got some space. If you want, you can take the space and sell your tomatoes and whatnot on the other corner. You can just give us maybe 10,000 rand rentals for that. But Incredible Connection, their business is selling laptops, not rentals. They are not a property company. But for whatever reason, they now have got this property that they are that they're lending and getting some income from. So that is what we call other income. We're saying that this is not your main business, but you got some money from other avenues. So you add in now other income. You take your gross profit, you add in other income, and then you get what we call the gross operating income. Then after your gross operating income, you've got your operating expenses. Now, your operating expenses, again, example of incredible connection, your operating expenses. You are saying that you needed to pay your salaries, right? Remember, you need to pay your salaries for your employees, right? Your employees, maybe you are giving them some lunch or some tea, or also the electricity in the shop that you are selling the laptops from, the security that you hired to make sure that everything is up to code and whatnot. So all the different little other expenses that you face now come under your operating expenses. So you subtract your operating expenses from the gross operating income and you get the operating income of the business. This is a very important thing. The operating, or EBIT, earnings before interest and tax, operating income of a business. Now, after the operating income of the business, you now ask yourself, where did we get the money to operate this business? Did we borrow money from someone? If we borrowed money from someone, we need to pay them some interest for the money that we borrowed. So we add in some interest income, we less some interest expenses, and then we get the profit before tax. Profit before tax, we get charged by the government some taxes. We pay the taxes, and then we get the net profit after tax. So that's how you do an income statement. So next week when we meet, we're also going to do just the same process that I've done right now. We're going to do the same for the balance sheet. We're going to do the same for the cash flow statement. We're going to do the same for the statement of changes in equity, so that you just get a basic overview. But I don't want you to get confused when we start bringing in the figures, so that you get a basic overview. Then once you have the basic overview, then we can now bring in an example, do it together in class. I give you a homework, you try on yourself, and so forth and so on until we are until we are done. So next week when we meet, we're gonna do the remaining 3 items: the balance sheet, the whatnot and whatnot, and then I'm sure we'll have enough time, because this is like 5 minutes just to do what I've done. I'm sure we have enough time to even do an example of the income statement, an actual example of the income statement, so that we can start on the workings. So please, next week, bring in your calculators, bring in your Excel sheet, because we will be starting on the calculation. Then for those of you that want to read ahead, I would say please focus on the income statement, because we are going to be doing some calculations on the income statement. Although we'll cover a little bit of other things, but our calculations will be on the income statement. So you can focus on that, and then next week we'll discuss further about how to do an income statement. All right. Are there any questions for me? Okay, no questions. I trust everyone is happy. Then again, just a reminder, from next week, all the classes that I'll be doing for financial reporting analysis will only be applicable for those of you that are interested and they've paid the fee. So this will be the last free lecture. Just thought maybe we at least cover the theory for free, and you can if you don't want to join, then it's up to you. But if you want to join, make sure that you've at least made the deposit. You don't need to pay the full amount. You can just pay a deposit and then pay it over 3 months or something like that, so that at least you can make a deposit, so I can add you to the group of the paid students, and then we'll be together. Then also just a reminder, Mondays we've got economics 1B. Wednesdays we've got introduction to functional areas of management, and then there are some classes that I'll be introducing next week: fundamentals of business management, fundamentals of macroeconomics, I think business communication. There'll be a lot of different classes that I'll also be introducing next week. Lusanda, you got a question for me? Lusanda?
Hi. Yes, I do. Can you hear me?
Yes, I can hear you.
Yes, I wanted to ask, but I think you've answered what I wanted to ask already, because I wanted to ask if you do lecture the other these other subjects, the fundamentals in of micro. Okay, I think you just say, hey, sorry, man. I'm looking at these books. Okay, so it's I'm not sure. It's business communication. Are you doing it?
Yes. Business communication, it will be on Tuesday.
Fundamentals of business management. Okay. Oh, is the number that at the bottom your number? Because I wanted to ask some questions about the payments and stuff.
Yes, that's my number. 071.
Okay, okay. I took it. I will text you.
All right. Thank you, Sandra. Any other questions?
Thank you.
Any other questions before we close for today?
Good evening, James. No, just a reminder, I logged in late today. Please don't forget to send us the presentation for today.
Okay, I'll do that.
Thank you so much.
Okay, thank you. Anything else, guys? Close. Okay, I think everyone is happy. Thank you guys for coming in.
Thank you.
Have a wonderful evening.
Thank you.
Bye. Thank you.
Mommy.